Good evening, everyone, and welcome to our 2024 fourth quarter financial market update call at Great Lakes Private Wealth. This is Dan Murphy, founder and chief investment officer of Great Lakes Private Wealth. I've titled tonight's call, Looking Out for Euphoria. The call tonight's being recorded and will be on our website, greatlakesprivatewealth.com, shortly afterwards. Now, let's get into what happened in the market in the fourth quarter and what we're seeing going forward. Pat Patin will give us some data, and then I'll update you on my outlook on the markets.
Thank you, Dan. This is Pat Patin, partner and portfolio manager of Great Lakes Private Wealth. Before I get started, I must remind everyone that past performance is no guarantee of future results, and all the information we'll be providing is from sources we believe to be reliable, but there's no assurance that the information is accurate or complete. Starting off with some key stats for our call, the 2024 price return for the S&P 500 was up 23.3%. The Dow Jones Industrial Average was up 12.9%. The Russell 2000 Small Cap Index was up 10%. The NASDAQ Composite was up 28.6%. International stocks represented by the EFA index were up only 3.8%. Gold was up 25.5%, and bonds represented by the Bloomberg Aggregate Bond Index total return were up 1.3%. Thanks for taking the time to join us today as we reflect on financial markets in 2024 and provide our outlook for 2025. As always, our goal is to help you navigate the ever-evolving investment landscape, keeping your financial goals and well-being at the forefront. Looking back on 2024, the market surprised many with the resilience. The expert consensus predicted a muted market, and that was the opposite of what occurred. Overall, the 2024 S&P 500 targets from these so-called experts range from 4,500 to 5,000 for the S&P, while the S&P 500 actually closed the year near 6,000. These experts only expected a 3% gain for the year, and the market was nearly 8 times better than that at 23.3% for the S&P 500 and 12.9% for the Dow Jones Industrial Average. The maximum drawdown for 2024 was 8.5%, along with 3 separate 5% declines. Historically, according to Ned Davis Research, the average year sees more than 7 3% dips and more than 3 mild corrections of 5% or more in a year. In fact, it is perfectly normal to see a 10% correction as well, as one happens on average once per year. While we've seen large drawdowns during years like 2022, 2020, and 2008, but looking back since 1980, the largest drawdown for the year has averaged about 14.2%. 23 of the previous 44 years saw a double-digit correction, with 13 of those 23 years still finishing positive. This kind of behavior is characteristic of a mature market. Volatility within a range, but ultimately moving upward. However, as we'll discuss, certain factors from 2024 may shape a more dynamic year ahead. While the experts predicted a small gain last year, we predicted a much more positive year than that.
In 2024, we got a lot more right than wrong, as evidenced by our results. I expected rates to go down very slowly, and in fact, I stated that on several of our calls. In the beginning of the year, most economists were expecting 4 to 5 rate cuts. I thought 2 to 3 at most. I was right. We got 3 rate cuts. I stated over and over the number one factor for the market focus was inflation. If inflation came down, that would give the Federal Reserve room to lower interest rates. I also stated that they would be slow to lower rates because they wanted to make sure inflation was dead, or at least it had no chance of accelerating again. This is what caused them to move so slowly on lowering interest rates. In fact, the first lowering of rates occurred in September. Now, one thing that did not pan out like we thought was that small cap stocks would do better in a lower or falling interest rate environment. That is how markets usually respond to lower rates. And you can see from the chart that Pat has put up on the screen for those watching on their computer is small cap valuations are near 20-year lows. Now, the small caps did okay, but large cap stocks continued to dominate the returns of all the market indexes. One of the key drivers of the market was that anything related to AI, artificial intelligence, did extremely well, from chips to software to hardware. We definitely had our share of exposure to AI. Another factor that contributed to our success was that we stayed mainly invested in US equities, which was a good call when you compare the US market's returns versus Europe and the China stock market.
Just as you said, Dan, our forecasts were pretty good for 2024, but 3 months have passed since our last call. What's changed since then? I'm going to hit on 4 of those to start. A new pro-business administration, business optimism, tariffs, and deregulation. Several key developments have altered the market landscape, both in the U.S. and globally. The market views the new Trump administration as pro-business. The idea that taxes will stay low or go lower. Business leaders are operating with renewed confidence, which has led to stronger forward guidance in capital investment. Business optimism is surging. The NFIB Small Business Optimism Index rose by 3.4 points in December to 101.1. The second consecutive month above the 51-year average of 98 and the highest reading since October 2018. The percentage of owners expecting the economy to improve rose to the highest since the fourth quarter of 1983. That's right, the best in over 40 years. This kind of sentiment can fuel economic growth, but it also warrants caution as markets become vulnerable to overexuberance. While the new administration has eased regulatory pressures, tariffs introduced during the Trump administration remain an overhang, complicating global trade dynamics. President Donald Trump has repeatedly threatened to dramatically expand tariffs. It's a move that could affect trillions of dollars in trade and reshape prices for everything from cars to medication, while potentially straining relationships with key U.S. trading partners. Imported goods are a key driver of the American economy, totaling $2.9 trillion in 2024, according to the U.S. Census Bureau, with China, Canada, and Mexico accounting for over 40% of that volume. It's these top trading partners that President Trump has frequently criticized, threatening a 10% tariff on goods from China and 25% tariff on goods from Mexico and Canada. On the flip side, deregulation in certain industries has provided businesses with more flexibility, supporting profitability and innovation. President Trump set a goal during his first term to eliminate 2 regulations for every new one. This time, he has said he wants to slash 10 regulations for each new one. The tone of deregulation is a very powerful catalyst for investment. Lower taxes and less regulation, especially on antitrust issues, should generate more interest in mergers, acquisitions, and initial public offerings. These thoughts manifest themselves through what we in the investment industry term animal spirits, or said another way, people are getting very optimistic, and that is driving markets right now. One of the newer developments since we last had our call is the Stargate project, an American artificial intelligence joint venture created by OpenAI, SoftBank, and Oracle. The venture plans on investing up to $500 billion in artificial intelligence infrastructure in the United States by 2029. This continues to show the increased importance of AI in both economies and politics, as every country and company views it as strategically important. Finally, cryptocurrency markets have introduced some turbulence the last few months on the belief that we will have decreased regulation in the U.S. While crypto remains a niche asset class, the broader financial market sentiment can sometimes mirror crypto volatility, and we're monitoring this very closely.
Well, so where does this leave us as we head into 2025? Let's start with what we do know for sure at this moment in time. Interest rates are likely to stay at current levels or move slightly lower. While this provides a supportive backdrop for equities, I would not call it outright bullish for equities. We would need to see much lower rates to be outright bullish on equities. As I said late last year, I believe we're entering a more normal period for interest rates going forward, with a bias to slightly lower rates this year. Is really causing some indigestion to the market is the fact that the Federal Reserve has lowered the Fed funds rate 3 times last year, starting in September with September's cut, and yet the 10-year Treasury has actually gone up. Last September, the 10-year Treasury was 3.65%. Today, with rates being lowered 3 times, the 10-year Treasury rate is at 4.63%. Almost 1% higher. These higher rates become competition for equities. The Federal Reserve is meeting this week, and I suspect they'll leave rates alone for now and say they're willing to lower rates again if inflation slows further or the economy starts to slow in any dramatic fashion. Otherwise, they'll leave rates as is for now, and that's my opinion as of today. Now let's review another key element we talk about on every call, investor sentiment. With all the computers and technical analysis and artificial intelligence, the one thing that never changes in the stock market is how investors react to good and bad news. Human emotions have not changed since the beginning of time. Unfortunately, investors either get too negative or too positive at extremes in the stock market. This usually leads to big rallies or big sell-offs when everyone gets to one side of the boat, so to speak. With this new administration in place, we've seen a shift from pessimism to a more positive sentiment on the outlook for the economy and the stock market. Since December, we've shifted from pessimism to a more neutral sentiment as of today. The CNN Fear and Greed Index, as you can see, is at 44, which is just close to the neutral zone, and it was solidly in neutral last week. The Ned Davis Daily Sentiment Indicator is just below the overbought zone. So we'll continue to watch these indicators very closely. Now, just last week, Ed Yardeni of Yardeni Research crunched the numbers and found that foreigners were purchasing U.S. equities at a record pace. They purchased $76.5 billion worth of stocks in the last 3 months. Yardeni stated that non-Americans have had an awful track record when it comes to investing in U.S. stocks. They were buying just before the 1987 market crash, just before the dot-com bubble in 2000, as well as just before the 2008 financial crisis. Just considering those 3 investment periods, you can see why we place so much importance on investor sentiment. While investors feel positive about the economy and the stock market, we need to guard against the dangers of euphoria, where irrational optimism can disconnect markets from the fundamentals. We're not there yet when comparing sentiment to past historical levels, but we really must watch this very closely this year. We're looking at relative valuations, and stocks aren't cheap by historical standards, right, Pat?
That's right, Dan. U.S. stocks are expensive by historical standards, but particularly compared to international markets. Fund flows out of Europe and China suggest that global investors are seeking opportunities where GDP growth prospects remain strong. Over the last 5 years, the U.S. has monopolized global capital with $1.2 trillion in inflows to U.S. stocks versus only $200 billion to the rest of the world. There is virtually no proof that valuations can predict what stocks might do the following year. Going out many years, there can be some advantage, but don't get sucked into avoiding the stock market because a talking head on TV tells you stocks are overvalued. We heard the same thing this time a year ago, and stocks have added another 20% since then. If you want to lighten up on overvalued parts of the market, that is fine. but to blindly go to cash could be a very bad mistake. While we have a framework for understanding the current environment, several unknowns could significantly influence markets. And there's still a lot of uncertainty in geopolitics, but there could be light at the end of the tunnel with various ceasefires proposed recently. If the wars in Ukraine and Israel were to stop, it could have a deflationary effect in certain areas due to the restoration of supply chains and reduced geopolitical risks, energy, food, logistics, and defense spending costs, just to name a few. Oil and gas markets would stabilize as geopolitical risk premiums diminish. Europe could see lower energy costs if gas supplies from Ukraine stabilize and Middle Eastern tensions ease. Ukraine is a major exporter of wheat, corn, and sunflower oil. Restoring its agricultural exports to full capacity would increase global supply, reducing food prices. Wars disrupt trade routes, leading to higher shipping and insurance costs. An end of conflicts would normalize these costs, making goods cheaper for businesses and consumers. Countries often increase military spend during conflicts, which can strain budgets and lead to inflationary pressures. Post-conflict periods typically see reduced defense expenditures, easing inflation. While this could be deflationary in specific areas, the broader impact would depend on how global economies and markets adjust to these shifts. Besides these wars, many economists have warned about the negative impact of the tariffs that President Trump plans to impose. While the market views it as a bargaining chip so far, others are very concerned about the deficits that these new policies may create. Some industries, particularly ones that rely on government contracts or chip making, as well as environmental, educational, and government service initiatives, will likely suffer. Others will benefit. We have to remember there will be both winners and losers under this administration. Inflation has moderated, but could we see deflationary pressures emerging from slowing global demand? This could emerge as a fear in the markets in the short term. Alternatively, could the economic benefits of artificial intelligence reignite inflation or cause so much added productivity that it ends up being deflationary?
Well, that's right, Pat. And with everybody looking at AI here recently, the uses of AI are ever increasing. And I'll give you one example. The other day, I was speaking to an accountant, and he mentioned when reviewing a new client's 700-page tax return that he used the AI app ChatGPT to analyze the return, and they compared to a prior accountant, and within a few moments, the app was able to detect a $3 in taxes paid error, and a single date was posted incorrectly as well. Now, for an individual person, this would have taken several hours to find these small, minor mistakes, and AI found it in just a few seconds. Another example, in November of 2024, the University of Virginia released results of a study they did with 50 physicians, along with the AI software tool ChatGPT. The study looked at how well doctors diagnosed a patient's condition on their own, as well as how accurate the diagnosis was when it was combined with AI software. The results were pretty amazing. They found that doctors' diagnoses by themselves were 73% accurate. If they used the AI software to help them make the diagnosis, they were 76% accurate. Now, here's the amazing statistic from the study. When they used AI software by itself, it was 92% accurate in making the correct diagnosis. How can this be? The problem with humans is they have biases. This can cloud a doctor's diagnosis. The AI software doesn't have any biases to deal with from their past. Many AI theorists believe that in the next 5 years, many cancers and health conditions will be completely eradicated because of AI's ability to come up with solutions accurately and, more importantly, very quickly. This is very, very exciting.
And last year, the market realized this exciting potential of AI, and that was reflected in the strong market in 2024. Looking ahead, we anticipate a more normal market environment in 2025, with expected returns in that range of 5 to 10%. However, we're also expecting heightened volatility compared to 2024. A normal market tends to mean 3 5% drawdowns and 1 10% correction during the year, which will require investors to stay disciplined during periods of turbulence. Since the early 1980s, there's been a greater than 5% drawdown in the S&P 500 index every year except two, in 1995 and 2017. And the S&P 500 has been up more than 20% in a given year, more often than it's been down. That's right, you're more likely to make 20% in the market in a given year than you are to be down historically. While the U.S. stock market remains the most attractive on a global basis, valuations are stretched and some degree of caution is warranted. Our strategy for 2025 emphasizes selectivity. We believe individual stocks will outperform broad indexes, and we are focused on high-quality companies with durable revenue growth and catalysts. At the same time, we recognize that some investors are hesitant to put money to work in this environment, which could create opportunities for long-term buyers.
Well, that's right, Pat. So again, I think it's important that we look at the perspective of historical returns for stocks and bonds. We've shared it many times in the past, but I think it's important to continue to remind ourselves of the long-term results of stocks over bonds. Again, since 1926, inflation's averaged 3%. Treasury bills have returned 3.3%, and bonds have returned 5.1%. The best performing asset class over time continues to be common stocks with a return of 10.4% since 1926. Again, this data is from Ibbotson and Associates. As Pat said earlier, the S&P returned 24.9% in 2024. As some of you may know, hedge funds historically have been an investment for the ultra wealthy. They typically charge a 1.5% management fee, and they take 15 to 20% of the profits a client makes. These hedge funds manage assets in the range of size from $1 billion to $50 billion in size. In 2024, the hedge fund index gained 9.6%. This is significantly below the S&P 500's 24.9%. Some of these large funds actually lost money in 2025. These results don't even consider the high fees that hedge funds charge their investors, which can amount to almost half of their annual return. And again, as we told you earlier, we had a very good year in 2024, and more importantly, we're off to a very good start in 2025. What I'm going to say next, though, may surprise some of you. If we're wrong with our forecast, we believe it will likely be to the upside. That for sure is not what most investors are preparing for currently. What in the world could lead us to believe that we could experience another strong year for the stock market? Well, what are the facts at this very moment? Or as Pat said earlier, what do we know for sure? We currently have a stable to slightly falling interest rates. We have strong corporate earnings. Innovation along with AI revolution could push markets higher than expected. The U.S. market is currently getting most of the world's investment dollars. We'll have record deposits into 401k plans this year as well. This, combined with huge corporate balance sheets enabling companies to continue to buy back their common stock. Sentiment is better, but not yet at an extreme level. We have a new administration that's considered pro-business. The overhang of uncertainty from not knowing who the president would be is now gone as well. One of the most successful investors of our time, Stan Druckenmiller, stated last week that in his 49 years of managing money, he has never seen this much optimism among corporate executives. All our main stock indicators are either neutral or positive. These are all very good signs telling us the market could go higher from here.
And if you're looking for more bullish signs, many of you have heard of the January barometer, or another way of calling it the first 5 days theory. The theory states that if stocks end the first 5 trading days of a new year with a gain, the market should net gains over the course of the next 12 months. Since 1950, the S&P 500 has logged net gains during the first 5 days of the year, a total of 47 times. Of those 47 instances, the index ended the year up in 39 of them. That's an 83% success rate for the first 5 days theory. Keep that in mind, though, that the S&P 500 is actually positive 73% of the time on average.
Now, let's not forget, every coin has two sides, and we wouldn't be doing our job if we're not keeping a close eye on potential warning signs. My biggest concern as it relates to a potential sell-off in the market is investors becoming overly optimistic or even euphoric about all the potential positives we're currently seeing, and they bid up stock prices to an unsustainable level. We know valuations are stretched currently, but can always become more stretched. We know foreigners are pouring money into the U.S. market, and that has never been a good sign. Of course, U.S. economic performance data is supporting them continuing to add money to the U.S. stock market. Inflation is moderated, but must be watched very carefully. And if it turns upward due to an overheating U.S. economy, or the rest of the world decides to join the party, or the war ends between Russia and Ukraine, this could lead to the type of euphoria I'm talking about and would set the market up for a very good sell-off. As always, we'll continue to monitor these developments and adjust your portfolios as needed to manage the risk while pursuing your financial goals. 2024 reminded us of the market's ability to adapt and thrive despite all these challenges. As we enter 2025, we expect more volatility, but also new opportunities. Our team remains committed to helping you navigate these changes with confidence, discipline, and a long-term perspective. We recently sent out an email to you, our clients, to let them know we've grown over 50% since we started Great Lakes Private Wealth. I want to especially thank you, our clients, for your loyalty and kind words of appreciation. You have my unwavering promise that everyone at Great Lakes Private Wealth will do everything in our power to continue to earn your trust. I look forward to talking to you in April of 2025.
This presentation is for informational purposes only and is not an offer or solicitation to purchase or sell any security or to employ a specific investment strategy. It is not designed for individually tailored to any particular investor and is not intended to be suitable or in the best interest of all types of investors. Opinions expressed in this presentation are subject to change without notice. There is no guarantee of any forecast made will be realized. Commodities, including precious metals, carry substantial risk and have experienced periods of extreme volatility. Investments in commodities may affect changes in the overall market movements, commodity index volatility, changes in interest rates, or other factors affecting a particular industry or commodity. Past performance is not a guarantee of future results. Investing involves risk, including the possible loss of principal. Index performance is for illustrative purposes only. Indexes are unmanaged, do not incur management fees, costs, and expenses, and cannot be invested in directly. Data contained herein from third-party providers is obtained from what are considered reliable sources. However, its accuracy, completeness, or reliability cannot be guaranteed. Data is as of the date noted and subject to change. Investment advisory and financial planning services offered through Summit Financial LLC, an SEC-registered investment advisor, doing business as Great Lakes Private Wealth. Summit Financial LLC does not provide tax or legal advice. If you require such advice, you should contact your appropriate tax or legal advisor. Thank you, and have a great night.